Hey everyone, welcome to today's webinar on how to evaluate and select socially responsible investments. Glad you're here. So this is meant to be an overview of kind of an introduction to socially responsible investing, also incorporating some terms like ESG, impact investing, some of the terminology you may have heard. I'm kind of putting it all in the broad category right now of socially responsible investing. And again, this is meant to be for those who are interested in aligning their investments in this direction, learning more about the space, some of the tools you can use to evaluate investments, and just to kind of get a better sense of how it all works. So let's jump in. So first, I'll introduce myself. For those who maybe don't know me, Michael Reynolds. I'm a certified financial planner. Also have a designation, which is called the CSRIC, the Chartered Social Responsible Investment Counseling certification or designation rather, also certified financial therapist designation, a few others. So I'm not trying to bore you with my alphabet soup, but just kind of letting you know some background. My firm is Elevation Financial. I am an independent firm, and I focus on those who, again, like to align their investments in this space. A lot of the people I work with do choose to work with me because they are interested in socially responsible investing. And I also do a lot of work in budgeting in the financial therapy space, as well as working with business owners. So fun facts about me, I'm also a cellist. I have a cello performance degree from when I was in college, and I still play occasionally for holiday stuff. Also a big sushi fan. Anyone who loves sushi, I'm always up for going for sushi. So that's kind of my favorite food of all time. And then anything with a racket, I'm a big fan of. I play tennis, pickleball, just got a ping pong table in our basement. So that's been fun. And huge Star Trek nerd, as you probably can see by the wall behind me. Got the NCC 1701 Enterprise blueprint from Next Generation. So big Star Trek fan. Website is elevationfinancial.com. Always welcome to reach out there. If you want to say hello, you can book a consultation, a money session, send a message. I also have a lot of articles, and my podcasts are there, a lot of information as well on my website. So it's elevationfinancial.com. All right, so let's jump in. Going to try and keep this pretty simple, short, and fast-paced. We're going to talk about some definitions and background on SRI, some of the history and trends, different elements and approaches to socially responsible investing, some of the benefits. Also just touch briefly on the criticism and the controversy. We can't talk about socially responsible investing without the criticism and controversy out there. And then ultimately just how to think about incorporating this type of methodology into your investments, and some tools and resources to give you some takeaways to kind of run with. So again, pretty short and simple. So let's jump into definitions and background. So what is socially responsible investing? And is that the only term used? The answer is no, that's not the only term that we use. There's various terminology that is typically used. There's socially responsible investing. There's ESG, which is probably the most common term we hear now. There is impact investing. And there is some overlap and some differences between them. So, like I said, a lot of different terminologies you might hear, a lot of different jargon you might hear. So, in any case, there's some overlap, there's some commonalities. Social responsible investing is kind of the blanket term we see a lot, but ESG is more of the term we see in marketing and in labels. So let's kind of talk about some of the differences. So social responsible investing is more of an umbrella term that defines this philosophy of aligning investments with good in the world, or a positive social impact or environmental impact. It was first practiced by the Quakers in about the 1700s. The Quakers made a point of avoiding interacting or investing in businesses that was related to slavery and other negative practices. So this type of investing has been around for a long time. It's not new and trendy necessarily. This is sort of the philosophical approach of avoiding stocks of companies with, quote, poor behavior. Now, poor is relative. There's a lot of different definitions of what that means. People have different values. People have different elements that are important to them. But ultimately, it's about avoiding stocks of companies that have what we would consider negative behavior in the eye of the beholder. Also, it can include investing in companies with favorable behavior, companies investing in practices or markets or areas that are considered positive impacts in the world. So it's an element of positive and negative screening. So for example, you might see mutual funds where you have mutual funds are made up of different stocks, hundreds, even thousands sometimes of stocks. And so, the favorable element might be focusing on companies that have a strong positive track record for treating the environment well or treating workers well. The negative screen might be avoiding fossil fuels or avoiding companies with problematic areas when it comes to treating employees fairly or social justice. So that's the philosophy behind socially responsible investing. ESG is probably the term you're most familiar with. ESG is similar in philosophy. It does take into account those types of elements: environmental elements, social elements, governance is the G. That's more related to corporate ethics, corporate behavior. But ultimately, it focuses more on a way of applying non-financial risk factors. So these are considered risk factors in addition to just sort of the right thing to do necessarily. So it does align with SRI, which is socially responsible investing, but the risk screening is really the goal. It's becoming the mainstream label that we apply to pretty much all of this stuff in general. For better or for worse, ESG is the label we're seeing as kind of the mainstream. So when you see a fund or a stock or something that says ESG on it, just know that it's really about the risk screening factor, but also it does align with this philosophy of working with companies that are have an element of positive impact in the world. So an example of the risk screening is, oil spill, fossil fuel industries, oil spills. An oil spill is a risk factor for that company's stock price, for that company's financial performance. It's also bad for the environment. So, to put it very plainly, companies that are at risk for toxic impact in the environment, such as an oil spill, that would be a negative risk factor, also a negative factor with the environment. So they're in alignment. But these ESG screening factors are designed to measure some of the non-financial risk factors in these companies and industries. And then impact investing, again, aligned with SRI and ESG as well, but it goes a step further. Impact investing includes an advocacy component. And a lot of this takes place within mutual funds that have this advocacy mandate within them. So the money that's pooled in these mutual funds goes not only toward, just the, buying the investments, but also toward funding advocacy, shareholder proxy voting, lobbying companies to enact change in those companies held within that fund. And we'll see some examples of this shortly, but it goes beyond just negative and positive screening and applying risk factors. It actually aims to enact real change, to encourage companies to behave differently, to behave better, to reduce their negative impact in the environment, to increase their positive impact in the environment, to make policy changes within the company to align better toward making a better impact in the world. So the impact component is one element of this space as well, which I find very important and often the most, no pun intended, impactful way to align your money. So who's interested in this? Who's interested in ESG and SRI and impact and this whole world of socially responsible investing in general? From an age standpoint or a generation standpoint, we're seeing that younger people care more about this, or it seems to be more of an interest. Now, there's lots of different data points, lots of studies here. This is only one particular study, but it does hold up pretty well when compared with others. So you see millennials, Gen Zs, large percentage of them are interested in this type of investing and aligning their investments in environmental, social, and governance areas to make a positive impact. Gen X as well, not quite as large of a percentage, but still interested. And then older generations don't see it as quite as important to them. So this is not meant to apply any judgment. It's meant to be factual and just informative to show you which generations are more interested in socially responsible investing and ESG risk factors as a whole. Also, what about growth? Is this becoming more of an interest and more mainstream and more important? Yes, it is. We're seeing phenomenal growth in investing in ESG and social responsible investment aligned investments. So just the chart speaks for itself. Pretty phenomenal growth in this area. So what are some benefits on the impact side? Obviously, there are some benefits just from philosophical alignment. You're kind of sending a message to companies of what's important to you. You're kind of voting with your investments. But you can also literally vote with your investments. Some of the benefits of the impact side of the equation are things like, fund families will, again, go the extra mile toward advocacy, toward encouraging companies to alter their policies and behavior. In this example, in a Green Century, which is a fund family, they pushed one company in their portfolio to eliminate deforestation from its supply chain by a certain date. That's a very tangible impact. That's a tangible change we've seen. By the way, this particular report you're seeing is a snippet from a tool I use called YourStake. It's not a consumer tool, so I'm not going to go into it too much or really talk about it at all because you have to pay for it. It's expensive. It's designed for advisors, financial planners like me. But just a shout out to YourStake for providing this data. That's one of the leaders in the space. And that's where some of this data is aggregated from. But literally, this data comes from the reporting and the advocacy reports you see on the websites publicly displayed by these companies. You can go research those individually as well, which we'll see some examples in a moment. So what are some criticisms on some of the controversy behind socially responsible investing in ESG? So it's kind of impossible to see this talked about online on social media without the controversy and the criticism. People love to criticize ESG. I'm just going to say ESG is a kind of a catch-all because it's shorter and it's the more common term. So when I say ESG, no, I'm not literally saying just ESG. I'm saying the whole space of this type of investing. So we'll say ESG. Some people say, well, it's better to just donate directly. I don't want to, get tangled up in putting my money into funds and having it, go through this ambiguous process of change. I'm just going to, buy low-cost index funds and I'm going to donate directly to nonprofits in my community, for example. Yeah, that's valid. That's not off base as a criticism. But my first response to that is, why not do both? Why not use some of your money for direct donations, some of your money to support direct nonprofits you believe in, and why not use some of your money also to align with investments that take a stance on the bigger picture and have change on a more corporate level incorporated into their efforts. So that's one way I would look at it. Is it's not an either or. You can certainly do both. Another way to look at it is, yes, it is important to support causes and organizations you believe in, especially in your local community. But I'm convinced that a lot of the massive systemic issues we have in this world can only be truly affected by massive enterprise level change at scale. So a lot of the problems we're seeing, for example, a lot of the environmental impact we're seeing by these huge companies, and that's where some of this negative impact is happening at a grand scale. These massive companies that hire and employ lots of people. They have influence over large, massive groups of people. So when it comes to the level of influence, these huge companies are really where the influence is happening. And if we can influence those huge companies to behave better, that I think is a more scalable way to enact change in the world. So that's the response I would have to some of the criticism. Another response or another criticism is ESG-like standards. Well, that's true to an extent. There is still some fragmentation in the space. There is still some evolving metrics and terminology, but that doesn't mean that it's not actually doing good in the world. So the space is evolving and will get better, in my opinion, but that's sort of a weak criticism, I believe. Also, another one, ESG funds are expensive. That has some validity to it. They're sometimes more expensive than others. In the ETF space, we're not seeing that as much. They're kind of getting to be on par with other types of investments, and we'll talk about ETFs in a minute. But it also is valid that some of the most impactful fund families do have higher expenses. They are more costly. So yes, there is some validity to that. But I don't think it's enough to just say, oh, they're more expensive and that's bad. For one thing, if you look at the returns net of fees, a lot of them are on par net of fees with their benchmarks or their equivalents that are just your typical low-cost index fund. So you're not necessarily seeing that the fees are eating up performance to the extent that there's a vast disparity. Another element is what's important to you. Yeah, saving money on fees is great, but if you're interested in donating money to make a change anyway, the money is going to go somewhere. Is it really that bad to pay a little more for your mutual funds if you are supporting the causes that those funds in particular are supporting and aligning with. So I think it's also sort of a problematic argument just to focus on the expense. Another one, ESG is just trend marketing. This one I agree with most, because you're seeing lots of mutual fund companies and institutions that are kind of, slapping ESG as a label on their funds and, acting like that is kind of their thing now. I don't know. It's subjective, but I'm convinced that to really get the deep impact, you want to go toward fund families that were founded on the premise of ESG and the socially responsible investing space. So I do agree to that with some extent, but that doesn't mean that the space is not effective. That doesn't mean that it's bad. That means that there are some companies that have hijacked this terminology and are using it for marketing, but you have that in many industries. So it is what it is. And then my favorite, ESG is just a liberal woke agenda. I'm using those terms not because I like them, but because they're commonly thrown around. Okay, we'll talk about this a little more here at the end as well, just kind of briefly an add-on to this. But I just want to say that it's not just about politics. It's become politicized for, because everything gets politicized. But I would argue that aligning your investments with things that are organizations or causes or efforts that are making a positive impact on the earth, that are taking care of people the right way, that are encouraging ethical corporate behavior. I don't know many people that are against those things. And so I get a little baffled and slightly, concerned when I see people, oh, it's just a liberal woke agenda. Not necessarily. Yeah, some of these elements can be more aligned with the liberal or the left side of the political spectrum. But I think if you kind of strip the politics away from it, most people would agree taking care of the planet's a good thing, taking care of people is a good thing, and encouraging strong corporate ethics and behavior is a good thing. And ultimately, that's kind of philosophically what this is all focused on. We can disagree on ways to get there, but I would argue that this is not just some, crazy liberal woke agenda. It's good for everybody. So how do you incorporate ESG? Doesn't have to be all or nothing. Some people say, well, I have to, revamp my entire portfolio and make a bunch of effort. And no, not necessarily. I mean, every little bit helps. I encourage you to get started with the basics. It's not as difficult as it seems to kind of get started. And we'll talk about some of the ways to get started here in just a moment. Perfection is impossible. I'm a big fan of progress over perfection. You're never, for example, going to completely avoid companies that are problematic. Every single company that you could invest in, no one's perfect. And every single fund you can invest in is going to have some problematic companies or industries in it. So perfection is impossible. But our goal is to do the best we can. Our goal is to align investments in the best way possible toward companies that are exhibiting good corporate behavior and positive global impact. So I would start by reviewing your own investments you already have. You can look at those ticker symbols, and you can plug those ticker symbols into some various tools to get some reporting. And let's jump into kind of what that looks like. So one of the best free resources out there is a site called Invest Your Values. And this is from an organization called As You Sow. And I make a recurring monthly donation to As You Sow. Their whole mantra is to, support efforts like this, to support efforts toward responsible, sustainable, socially responsible investing. And their tool is incredibly robust. And again, it's free and it's publicly available. So again, that's called Invest Your Values. If you Google Invest Your Values, it should be in the front, the first page results somewhere. Maybe put on As You Sow at the end of it, and you'll find it for sure. Look for that label. So here's an example of some fund screening you can do with Invest Your Values. And by the way, before I go any further, there's no endorsement or affiliation implied with any fund you see here. You might see some ticker symbols here. These are simply examples for educational purposes. This is not a recommendation. None of this is an affiliation or an endorsement of any kind. So this is an example of comparing VOO, which is a fund that tracks the S&P 500. It's the Vanguard VOO. It's a very popular ETF. And then the right-hand side, you'll see the Parnassus Core Equity Fund, also a large cap focused fund. I'm not saying they're like exactly equivalent, but they do kind of match up in terms of benchmark. So the S&P 500 is the benchmark used for the Parnassus fund you see here. So if you look at the investor values tool and plug in the ticker symbols for each one, you'll see that it generates a report showing you some scoring. So they're scoring in different areas: fossil fuels, deforestation, gender equality, civilian firearms, prison industrial complex, military weapons, tobacco. So these are all scores based on, in this case, avoidance of these areas. So obviously the S&P 500, very problematic in terms of lots of exposure to fossil fuels, et cetera. On the right, this Parnassus fund, not perfect, but much lower in terms of exposure to these particular areas. And so that's kind of one of the reports you can get from investor values when you plug in those tickers. You can also go deeper. One thing I love about this tool is that you can click on certain specific elements. For example, if you click on the fossil fuels element, you'll see some deeper reporting on exactly what's happening within that fund. You'll see the score, you'll see, the specific companies that provide the at-risk exposure or the problematic exposure. You'll also see in the gender equality metric, there's a different kind of report you'll see there. The fossil fuel holdings, the social impact, all these areas you can click on and get specific details on where some of the problematic areas might be. Just as a contrast, I plugged in, the Vanguard Total Stock Market Index Fund. Again, no endorsement or affiliation implied here, but you'll see a much different scoring here. You'll see much different areas and a greater exposure to some of these problematic areas in that fund. So that's how you can compare these funds and see how your particular investments stack up. Investor Values also has a really nice screening tool. So if you're looking for ideas and what funds you might want to invest in, you can actually click on their screening tool and put in information that kind of narrows down what you're looking for. So if you're looking for a large cap fund, if you're looking for a total market fund, or if you're looking for international, you can put in those attributes and then get a list of funds that are ranked and scored according to these metrics. So again, I say this over and over, but no endorsement applied. If you see ticker symbols, it's just examples, no endorsement of anything here. Another resource for finding funds that align with these philosophies is USIF, which is the Forum for Sustainable and Responsible Investment. So USIF maintains a list of mutual funds that align with different areas, that are considered socially responsible investments, that have ESG as a foundational element. And you can find some ideas and examples on the USIF site as well. USIF is one of the leading organizations in this space as well. They also have great education. So if there's a free course you can take as well as a consumer that teaches you more. So on the impact side, it's great to screen and look for high scores and look for avoiding exposure to problematic areas like fossil fuels, social issues. But I really like going into the impact side. I look looking for reports and seeing exactly what these fund families are doing in terms of proxy voting and shareholder advocacy. So Parnassus and Calvert are two of the fund families that are leaders in this space. So Parnassus, for example, on their website has numerous reports showing, their stewardship report, for example, has a detailed dive into the impact their funds have created, the change enacted in companies in their portfolio. Same with Calvert. They have deep reporting into some of the positive change in the world that has happened as a result of their efforts and the money pooled in these investments. So the impact I find to be extremely interesting and extremely useful in this space. That's kind of, to me, where the change really happens. So I've talked a little bit about mutual funds. I've kind of mentioned ETFs. I'm going to briefly just kind of, again, this is very introductory. It's meant kind of for beginners. So if you're curious about the difference between mutual funds and ETFs, this is not a full webinar on that, but just a couple of elements to watch out for. So mutual funds and ETFs have a different tax structure. You'll find that ETFs are often more tax efficient inside taxable accounts. So if you're inside of like a Roth IRA or an IRA or a 401k, tax efficiency is not a factor because those are all tax deferred or tax-free growth accounts. But if you're in a brokerage account, like a taxable account that is not a retirement account, tax efficiency becomes more of a concern. So again, not a one size fits all, but oftentimes you'll find that ETFs are more favorable in those types of accounts. So talk to a professional for more specific information, but that's kind of one element to look out for. Also, at least as of now, Some of the most impactful funds are typically going to be mutual funds. This is changing. A lot of the industry is shifting toward the ETF structure, but much of the impact and the deep impactful funds are still going to be mutual funds. As a side effect, they tend to be more expensive as a result also. So it's a trade-off. You may be paying a little more for them. They may not be as tax efficient. So just be aware of where you're placing investments in your portfolio and in your accounts for tax efficiency, if that's a factor for you. You can also do stock analysis. There's a few tools I like for stock analysis. I don't recommend a lot of single stocks. I do have, a limited exposure to some single stocks when appropriate. But if you are doing stock analysis, there's a tool called Morningstar Sustainalytics tool. And if you just Google Morningstar Sustainalytics, you'll find this. And you can plug in a ticker symbol for a stock, and it'll give you an ESG score with risk factors. And I'll kind of give you some metrics there. Another tool I like is the MSCI ESG ratings tool. Again, Google MSCI ESG ratings. You'll find this one. Very similar. You can plug in both funds and stocks, but single stocks are one of the things you can reference and rate here and score, and it gives you some ESG scoring as well. So if you're interested in single stocks, seeing what their ESG metrics are, those are some tools you can use. So overall, there's a lot of new thematic funds coming out. Thematic being like focused on like vegan friendly and animal cruelty friendly, and lots of other funds that are very, very niche and thematic. That's great that we're getting so many options, but you also want to watch out for making sure the fund is reliable and has a good track record, and it's got some element of sustainability, no pun intended, from a financial standpoint. So what I look for in funds, if you're looking for ESG funds to incorporate, I typically am going to look for a track record of more than 3 years. So the fund's been around at least 3 years. I'm going to look for low manager turnover. So I want to make sure the portfolio team on the fund has been around for at least 2 or 3 years. I'm looking for at least $75 million in assets. This is across all asset classes. So, if you're seeing like A shares and I shares, et cetera, it's across all of them. So also I'm looking for 80% of the underlying securities are going to be consistent with the broad asset class. What that means is if it's a large cap fund, make sure most of its securities are large cap securities. Also aligns with its peer group in that space, large cap, et cetera. Look for a Sharpe ratio that is on par with its peers. A Sharpe ratio, you can find that label in the fund facts. It's basically a measurement of risk-adjusted return. You don't have to necessarily know what it means or how to calculate it, but just know that you want it to be fairly on par with other funds in its benchmark category. And then also performance and expense is a factor, but it's not the most important. Performance is hard because past performance, as you know, does not equal future returns. So, you can't really chase returns necessarily and expect performance to continue the same way it always has. But it didn't hurt to look at as well and make sure that there are at least some historical precedent there. And then expense also. Again, expense, I think, is not the most important thing, but all things being equal, if you have options and one fund is lower expense, yeah, that could be worth choosing. So ultimately, I kind of mentioned I'd touch on this at the end as well. So ultimately, the goal of this type of investing is to make a positive impact in the world. It's become political, and I'm not crazy about that. But I do want to say that, there's really something for everyone in this space. And I don't mean like, hey, if you're far right or far left, you find a fund that's far right or far left, like you can do that, yes. But ultimately, most funds in this space, most ESG focused funds focus on the E, the S, and the G, which is the environmental impact, the social impact, the governance impact. So ultimately, again, I don't know too many people that are against these principles. The principles are, hey, let's take care of the earth, preserve our natural resources, preserve the beauty of the earth, preserve its ability to sustain life. Those things I don't think are really in dispute too much. And no matter your political spectrum or religious affiliation, if you're a Christian or religious, for example, most major religions have this general belief that taking care of the earth and being good stewards of the earth is a good thing. Like in general, I think we can kind of agree on that, right? The S, the social impact, taking care of people, being inclusive, treating people with respect, treating your employees well, having a positive, encouraging, supportive workplace, fighting racism. These are all things that I kind of think we can agree on, right? No matter where you are on the political spectrum. And then the G, encouraging companies to follow ethical behavior, transparency, good corporate ethics. I don't know of too many people that are against that as well. So I try to consistently introduce some level of rational sanity to the controversy around ESG, because I don't think there is a controversy. I think if you really look at what the efforts are here, it's about making the world a better place. And yes, we can agree on the politics of how we get there, but ultimately, these are things that I think as a society we can and should all agree on. So that's why I'm excited about this space. So I hope this has been helpful as an overview on kind of getting started with socially responsible investing. Always happy to take questions. If you have any questions about this or anything else, feel free to reach out. My email is michael@elevationfinancial.com. And my website, as you can probably guess, is elevationfinancial.com as well. So I'd love to hear from you. Feel free to reach out. You can book a consultation anytime you want to, or send me a note, or find me on social media, and I'm happy to help any way I can. So with that, thanks for joining today. Have a great day. We'll see you next time.